When a bank collapses, they don't announce it in advance. They don't send you a letter saying your deposits are at risk. What happens is this. You walk to the ATM on a Tuesday morning. Your card doesn't work. You call the bank. The line is busy. You drive to the branch. The doors are locked. And on the window is a notice from the government explaining that your account has been restructured for the stability of the financial system. That's not theory. That's what happened in Iceland in 2008, in Argentina in 2001, in Weimar Germany in 1923. 3 times, 3 countries, the exact same sequence. And every single warning sign that preceded those collapses is present in the United States right now. This is the story of how banking systems die, why governments always choose inflation over honesty, and why the math says your deposits are not as safe as you think. Because when you study the pattern, when you look at the forensic evidence from 3 separate collapses across a century, you discover something disturbing. Bank failures don't happen by accident. They happen by design. And the people who get hurt are always the ones who trusted the system most. Before we go through the 3 stages, you need to understand what a banking collapse actually looks like. Not in textbooks, in practice, when the doors lock and the money disappears. A banking collapse is not a slow decline. It's a sudden rupture. One day, the system works. You can withdraw cash, transfer funds, pay bills. The next day, you cannot. And the government steps in not to protect you, but to protect the system from you. Because when a bank fails, the problem isn't that the bank is insolvent. The problem is that everyone knows the bank is insolvent. And if everyone tries to withdraw at once, the entire financial system collapses. So governments intervene. They freeze accounts. They impose capital controls. They restructure deposits. And they call it stabilization. But what it really is theft. Legal, organized, politically justified theft. Your money doesn't vanish into thin air. It's converted into something worth less. A new currency, a government bond, a promise to pay you back later at a fraction of the value. This has happened 3 times in modern history. And every time, the sequence was identical. Let's start with the first example. Weimar Germany, 1923, the most famous hyperinflation in history. After World War I, Germany owed massive reparations to the Allies. The government couldn't pay with taxes. The economy was destroyed. So they did what every failing government does. They printed money. At first, slowly. Then faster. By 1923, the printing presses were running 24 hours a day. The mark, which had been 4.2 to the dollar in 1914, hit 4.2 trillion to the dollar by November 1923. Let that sink in. 1 trillion to 1. Stage 1, unsustainable government debt. Germany owed reparations it could not pay. The Versailles Treaty demanded 132 billion gold marks. That's roughly $400 billion in today's money. The German government had 3 options: default and face occupation, raise taxes and trigger revolution, or print money and destroy the currency. They chose option 3, and the consequences were catastrophic. Stage 2, banks fracture. As inflation accelerated, people stopped trusting the mark. They spent money as fast as they received it because holding it meant losing value every hour. Workers demanded to be paid twice a day so they could buy food before prices doubled. Savings accounts became worthless. A middle-class family that had saved 10,000 marks for retirement found it worth less than a loaf of bread. Banks, which held deposits in marks, were sitting on nothing. The assets evaporated. And when depositors tried to withdraw, the banks couldn't pay. Not because they'd made bad loans, but because the currency itself had died. Stage 3, the restructuring. In November 1923, the German government introduced a new currency, the Rentenmark. They declared 1 Rentenmark equal to 1 trillion old marks. If you had 1 trillion marks in your account, you now had 1 Rentenmark. Your life savings converted at 1 trillion to 1. The government called it monetary reform. What it actually was confiscation. Everyone who held marks lost everything. Everyone who held real assets, gold, land, foreign currency, survived. The lesson from Weimar is clear. When the government cannot pay its debts, it will inflate the currency. And when the currency collapses, it will restructure deposits. You don't lose your money to a bank run. You lose it to a government decree. Now let's jump forward 78 years. Argentina, 2001. A different country, a different currency, but the exact same pattern. In the 1,990 seconds, Argentina pegged the peso to the US dollar at 1 to 1. The government promised the peg was permanent. Investors believed it. Money flowed into Argentine banks. The economy grew. But beneath the surface, the debt was unsustainable. Stage 1, unsustainable government debt. By 2001, Argentina owed $132 billion. The economy was shrinking. Tax revenue was falling. And the government was borrowing just to pay interest on old debt. The peso peg required Argentina to hold enough dollar reserves to back every peso in circulation. But the reserves were depleting. The government was running out of dollars. Stage 2, banks fracture. In 2001, depositors started to panic. If the peso peg broke, their savings would lose value overnight, so they tried to withdraw dollars and move them abroad. In November 2001, the government saw the run coming, and they imposed the corralito, the little fence. Argentines woke up to find their bank accounts frozen, withdrawals limited to $250 per week, transfers abroad blocked. The doors didn't physically lock, but the effect was the same. Your money was trapped. Stage 3, the restructuring. In January 2002, the government abandoned the peso peg. Overnight, the peso went from 1 to 1 with the dollar to 3 to 1, then 4 to 1. If you had 10,000 pesos in the bank, equal to $10,000, it was now worth $2,500. You lost 75% in a single weekend. The government called it a necessary devaluation. What it was confiscation. And the people who got hurt were the middle class. The people who had saved. The people who trusted the banks. The lesson from Argentina is the same. When the government cannot pay its debts, it will devalue the currency. And when it devalues, it will trap your deposits so you cannot escape. You don't lose your money to inflation. You lose it to capital controls. Now, the most recent example, Iceland, 2008. This one is different because Iceland was a wealthy, developed nation. It had a stable currency, a functioning democracy, and sophisticated financial regulation. And it collapsed in 7 days. In the early 2000s, Iceland's 3 largest banks, Kaupthing, Landsbanki, and Glitnir, went on a borrowing spree. They offered high interest rates to foreign depositors. Billions flowed in from the UK, the Netherlands, Germany. By 2008, the 3 banks held assets worth 10 times Iceland's GDP. They were enormous, and they were leveraged to the breaking point. Stage 1, unsustainable bank debt. Iceland's banks owed $100. Iceland's entire economy was $10 billion. The banks had borrowed in foreign currencies, mostly euros and pounds, and they'd lent in Icelandic krona. This created a currency mismatch. If the krona fell, the banks would owe more than they could ever repay. Stage 2, the fracture. In September 2008, Lehman Brothers collapsed. Global credit markets froze. Iceland's banks couldn't roll over their short-term debt. They tried to borrow from the Icelandic central bank, but the central bank didn't have enough foreign currency. On the 6th of October 2008, the Icelandic government seized control of Landsbanki. On October 7, Glitnir. On October 9, Kaupthing. All 3 banks gone in 1 week. Stage 3, the restructuring. The Icelandic government couldn't bail out the banks. The debts were 10 times the size of the economy. So they imposed capital controls. Icelanders could not move money abroad, could not buy foreign currency. The krona collapsed 50% against the euro. If you had savings in krona, they lost half their value. Foreign depositors, mostly in the UK and the Netherlands, lost everything. The government called it a controlled resolution. What it was a nationalized bankruptcy. The lesson from Iceland is the most important. Even wealthy, stable countries can experience sudden, total banking collapse. And when it happens, the government will not protect depositors. It will protect the currency and the financial system. And if that means freezing your account, devaluing your savings, or restructuring your deposits into worthless bonds, that's what they'll do. 3 countries, 3 collapses, 3 identical patterns. Stage 1, the government or the banking system takes on debt it cannot repay. In Weimar, war reparations. In Argentina, dollar-denominated government bonds. In Iceland, foreign currency bank debt. The specifics differ, but the math is the same. The obligations exceed the ability to pay. Stage 2, the fracture. The banks or the currency start to break. In Weimar, hyperinflation destroyed the mark. In Argentina, depositors tried to flee the peso. In Iceland, the banks ran out of foreign currency. This is the critical stage. The system is breaking, but most people don't see it yet. The government insists everything is fine. The banks promise stability, but behind the scenes, they're preparing stage 3. Stage 3, the restructuring. The government intervenes. It freezes accounts, devalues the currency, or converts deposits into something worthless. In Weimar, a 1 trillion to 1 conversion. In Argentina, forced pacification and a 75% loss. In Iceland, capital controls and a 50% currency collapse. The people who get hurt are always the same. The savers, the middle class, the people who trusted the system. Now, let's talk about the United States in 2025 and why every warning sign is flashing red. Stage 1, unsustainable debt. The United States owes $36 trillion in federal debt. That's 120% of GDP. Interest payments alone are approaching $1 trillion per year. We're spending more on interest than on defense. The government runs deficits every year, $1.8 trillion in 2024. During peacetime, in a growing economy, we borrow to pay interest on previous borrowing. That's unsustainable. Just like Weimar borrowing to pay reparations. Just like Argentina borrowing to defend the peso peg. Just like Iceland's banks borrowing to fund expansion. But it's not just the federal government. Commercial real estate debt in the United States is over $5 trillion. Office buildings are empty. Remote work is permanent. Property values are falling. Banks that lent against those properties are sitting on losses. In March 2023, Silicon Valley Bank collapsed. Then Signature Bank, then First Republic. 3 banks failed in 2 months. The government stepped in with emergency lending. The FDIC and the Federal Reserve provided liquidity. But the underlying problem didn't go away. Regional banks are holding commercial real estate loans that will never be repaid. The assets are bad, the losses are real, and the fractures are forming. Stage 2, the fracture. We're here right now. The cracks are visible if you know where to look. Regional banks are under stress. Depositors are moving money to larger institutions. The Federal Reserve is providing emergency liquidity to prevent runs. But liquidity doesn't solve insolvency. If a bank has lent $1 billion against office buildings now worth $500 million, no amount of short-term borrowing fixes that. The loss is permanent. And when enough banks have enough bad loans, the system fractures. Look at the pattern. In Weimar, the fracture was hyperinflation. In Argentina, it was capital flight. In Iceland, it was foreign currency shortage. In the United States, it's commercial real estate losses combined with rising interest rates. The mechanism is different. The result is the same. Banks that look stable start to break. We're not at stage 3 yet, but we're closer than most people realize. Stage 3 is when the government intervenes, when they freeze accounts, impose capital controls, or restructure deposits. And here's what nobody wants to say out loud. The United States has already done this before. In 1933, Franklin Roosevelt signed Executive Order 6102. It required all Americans to turn in their gold to the government at $20.67 per ounce. Then the government revalued gold to $35 per ounce. Everyone who surrendered gold lost 41% overnight. It was legal confiscation. In 1971, Richard Nixon closed the gold window. Foreign governments holding dollars could no longer redeem them for gold. The promise was broken. The dollar became pure fiat, and everyone holding dollars lost purchasing power as inflation accelerated. The government didn't call it default. They called it closing the gold window. But the effect was the same. The promise was not kept. The lesson is clear. The United States government will protect the system, not the depositors. And if protecting the system requires restructuring deposits, devaluing the currency, or imposing controls, they will do it. They've done it before, they'll do it again. So what survives when the banks collapse? History gives us the answer. In Weimar Germany, those who held gold preserved wealth. The mark went to zero. Gold stayed gold. Those who held foreign currency, dollars, Swiss francs, survived. Those who held marks lost everything. In Argentina, those who held dollars survived. The peso collapsed. The dollar held value. Those who moved money abroad before the Corralito were protected. Those who trusted the banks were trapped. In Iceland, those who held foreign assets survived. The krona collapsed. Sterling and euros held value. Those who kept savings in Icelandic banks lost half. The pattern is consistent. Hard assets survive. Gold, land, foreign currency, anything the government cannot print. Paper promises fail. Bank deposits, government bonds, local currency, anything denominated in the collapsing system evaporates. This isn't speculation. This is forensic analysis of what actually happened 3 times in modern history. Here's the specific mechanism. When a currency collapses or a banking system fails, value doesn't disappear. It transfers from paper to hard assets, from local currency to foreign currency, from bank deposits to physical goods. The people who understand this in advance position themselves to survive. The people who trust the government's promises lose everything. In Weimar, smart money bought real estate, farmland, gold, anything real. By 1924, when the hyperinflation ended, those assets had preserved wealth. The marks were worthless, but the land still had value. In Argentina, smart money moved dollars abroad before the Corralito. They bought property in Uruguay, held accounts in Miami. When the peso collapsed, they were protected. In Iceland, smart money held foreign currency. When the krona fell 50%, those with euros or pounds maintained purchasing power. This is not financial advice. This is historical fact. When systems collapse, hard assets preserve wealth. Paper promises do not. And the United States is in stage 2 of the collapse pattern. The debt is unsustainable. The banks are fracturing. And stage 3, the restructuring, is coming. Maybe it happens in 5 years, maybe 10, maybe sooner. But the pattern says it's inevitable. You cannot borrow forever. You cannot print forever. And when the system breaks, the government will not save your deposits. They will save the system. And if that means your savings are restructured, devalued, or converted into something worthless, that's exactly what will happen. 3 countries followed this pattern: Weimar, Argentina, Iceland. Each time, the people who trusted the system lost everything. Each time, the people who held real assets survived. The United States is walking the same path. The debt is unsustainable. The banks are stressed. The fractures are forming. And history says stage 3 is not a question of if, it's a question of when. If this opened your eyes to where we are in the sequence, subscribe. Because when stage 3 begins, when the restructuring happens, you'll want to understand what's happening and why. The answers aren't hiding in the future. They're written in the past. And history has already shown us exactly how this ends.